Alphabet and Microsoft reported earnings after the bell yesterday. Both companies reported better than expected earnings and revenue. But Google's cloud revenue missed expectations, and as a result, that stock is down by about 6.8%. Joining us right now is Paul Meeks. He's a veteran tech investor and professor at the Baker School of Business at the Citadel in Charleston. And Paul, let's dig through these numbers. If you were just looking at the quick read on the earnings report on this, you would have said, OK, great news. They came in with earnings and revenue above expectations. What happened with Alphabet? What's the big disappointment?
Well, you hit the nail on the head. They were expected to deliver $8.6 billion in Google Cloud revenue, and they came in with $8.4 billion. Now, they don't give guidance. So this was a Wall Street estimate calculated by Wall Street. The $8.4 billion is still 22% growth. And even though Microsoft, with its cloud business, Azure, grew 29%, so they gained some share, it's still pretty robust growth by Google. And I actually think that the reaction today, down 7% on a miss that was about $20 million on an over $8 billion number, is a gross overreaction. I actually think Alphabet's a pretty compelling buy right now, today.
OK, that's a strong move on this. If you want to dig through the rest of what was happening there, you probably liked a lot of what you saw when it came to advertising and some of the other areas where they've operated pretty well. What did you think digging through the rest of the numbers for Alphabet?
So digging through the rest of the numbers, and I was on the quarterly webcast live, everything looked pretty good. And of course, this company, until further notice, is going to be driven by the digital ad market. And that accelerated in all kind of subsegments within that. And so I'm pretty pleased. Joe said the right thing at the beginning of the segment, that nothing looks good, including Google, other tech stocks, and maybe even generally other stocks in overall. Technicals look pretty poor. So do you rush in and buy Google aggressively? I'd actually buy it. Today, the stock's going to break through its 50-day moving average, which is 134. We'll open at 129. I think that you buy a little bit and maybe scale into Alphabet in that range of 125 to 115, more for technical reasons, not because we've had a poor inflection in fundamentals with that cloud business. I think they're going to be just fine over time. I don't think this is really that relevant.
Let's talk a little more about the technical issues. What concerns you? Where do you think we're headed?
Yeah, unfortunately, we've had a nasty breakthrough through the 50-day moving average, and it'll be on some pretty high volume this morning. So that looks pretty bad. We've been in this range above the 50-day support ever since very early 2023. And so, yes, that's why I suggest maybe you buy a tidbit based on what I think is an overreaction to the Google Cloud revenue miss, but scale in over time, because we could go lower. We could go down to 125. Maybe even 115 on the downside. But yeah, the technicals or the price chart looks, unfortunately, pretty nasty for this company, despite its long-term fundamentals are solid. And so I would go in, as I said, kind of slowly and deliberately, more for a market technical reason than a fundamental reason.
So if it's not fundamentals and it's the technicals you're watching, what do you think is driving the technicals? Is it the broader issues facing the uncertainty, facing the markets, facing the economies, facing global peace at this point?
You're absolutely right. And I like the discussion that you had at the beginning of the show. Yeah, we have a lot of issues, the geopolitical concerns, the lack of a speaker in the House of Representatives. And of course, with tech stocks, they are uber sensitive to the movement in rates. And the big jump that you had in Alphabet and other tech stocks earlier in the year was based on the premise that before we got to the end of 23, we would start to lower rates. And now we have maybe one ratchet up, and that's really not much of a big deal. We're very close to the end of the rate hikes, but higher for longer. If we don't start to lower rates, maybe until even this time next year, that's the biggest problem of all with any of these aggressive growth stocks, Alphabet and others included.
Well, Microsoft shares are up by better than 3% this morning. Do you like those shares, too? Because it looks like they beat on every metric, and their cloud spending cloud revenue looked really good, too.
Yeah, their cloud revenues accelerated, which I thought was very impressive. They also talked that they now have 1 million subscribers, paid subscribers for Copilot. So you get a little bit of that AI push finally. But I would own Microsoft. I do own Microsoft. I would own Alphabet. I do own Alphabet. But I would buy Alphabet today on this weakness. I think Microsoft is fully priced. Wouldn't buy it, wouldn't sell it, would just hold it. But I do see opportunity in Alphabet shares.